Oh, that's not the view I want. There we go. What's going on, guys? Happy Friday. Welcome back to another Dividend Happy Hour. I hope everyone had a great week. Finished up a bit up this week, I would say. I don't quite remember what we were at in the last live stream, but I'll show you guys where we're sitting right now. Let me jump over to my spreadsheet. Let's bring that up here on the screen. So, guys, we are at 98,349. So we still have not hit the six-figure mark. I was talking about it with Ari a couple days ago on the our deep end, and I just feel like, I'm just hovering 97, 98, get up to 99, then back down to 98, maybe even dip down as low as 96. So we're hovering within a range. And maybe it was from last week's live stream. Someone left a comment, and they said something like, I didn't count myself as hitting that 100,000 mark really until I got up to, like 110 or 120,000 in the portfolio for this exact reason, because you tend to do some hovering. So, and that's going to be the thing. As soon as we do hit the six-figure mark, it's just going to hover, between 100,000, 101,000, then it'll go down to 99, then probably back down to 98. And so, we're just going to be in this hovering stage for quite a while. But we finished up, pretty good, up $250 for the day. So, overall, I think we're inching closer and closer to it. And we'll see what happens next week. I don't want to jinx it. Next week could be the week. But enough about me, guys. I hope everyone had a fantastic week. Hope you guys are all doing well. I'm so stoked to see all of you guys tonight. I see a lot of good people here in the live chat, guys. Good to see everyone. 86 people here in the stream. I don't know. Tell me about you guys. Were you guys up this week? Were you down? What's been going on with you guys? Anything worth sharing here? Yes, Matt, I see this question right here. A question about the spreadsheet. Is the dividend growth rate still based on the 5-year? Yes, it's all from Seeking Alpha there. Exactly. Yeah, Midway Pipers up a bit, $410 today. Nice. Very nice. Guys, why don't we kick this thing off the best way we know how? Grab whatever it is you're sipping on. Oh, yeah. It is, let me tell you guys, it is Fresco Clock. Love it. Back with the Fresca tonight. No 7-Up. I actually think we're out of 7-Up. But anyway, grab whatever it is you're sipping on. Here's to you guys. Thanks for tuning in and hanging out with me for this next hour. Going to be a fun live stream. I can feel it. I mean, they're all fun, but I don't know. I'm happy to see you guys. So cheers. Here's to you guys. And also here's to the dividends, the pursuit of that sweet, sweet cash flow, because that's really what's bringing us together tonight. So cheers. Oh, that is so good. Oh, wow. One more, actually. Delicious. Delicious. Guys, let me know if you think a few things here in the live chat. I want to know, number one, what did you buy this week? I can see that it looks like a lot of you guys were up, not only today, but for the week. Like, D. Connor here is up 4.3% for the week. That's crazy. But anyway, let me know what you guys bought this week. Which stocks did you add to? I think we're going to see a lot of Pepsi tonight. Pepsi seems to be like the most popular dividend stock out there right now. At least from what I can see. I see been seeing a lot of Pepsi in the comments. So let me know what you picked up this week, number one. Number two, what are you sipping on? You got anything good tonight? Did you bring anything good to drink to the Dividend Happy Hour? Like Chris here, who's got a Ghost, sour watermelon Ghost. But let us know what you're sipping on over there. Matt's got his sweet tea. Number three, did anything cool happen in your guys' portfolio this week? I know D. Connor was up 4.3%. Looks like Sir Dude Broman is up up quite a bit as well, thanks to his favorite unicorn, which is going to be Broadcom, Mr. Broadcom over here. So yeah, let me know if anything cool happened to you guys this week. And also number four, I want to know if we have any first timers here in the live stream. If this is your first time tuning into the Dividend Happy Hour, just so you know, we do this live stream every Friday night, starting at 5 p.m. Pacific time, 8 p.m. Eastern time. And it's really just like a random hour of hanging out, talking stocks, and no plan, just seeing where it goes. But let me see what you guys have picked up this week. Let me see. Shane here, SHD, Clear Secure. Nice. Clear Secure. I'm almost back to break even with Clear Secure. I love that. And Vici Properties. Nice. Good stuff. Fernando picked up some FedEx during the dip after earnings. Nice. I like FedEx better than I like UPS. I think FedEx is still looking pretty solid. UPS, I'm a bit concerned about the dividend safety. Wishing good things for UPS, but I'm seeing some red flags there. Let's see, Matt, nice little shopping spree here. Look at this, guys. So picked up some Blue Owl, some VFIAX, Zoetis, Waste Management, SCHD, there's Pepsi, and United Health up 5% for the week. Nice. Good stuff. Kyle picked up some Hess and Energy Transfer. Very nice. Dan focusing on Visa again. Oh, man, and what a way to celebrate with a big glass of chocolate milk. So tell us about this chocolate milk. Are you Nesquik powder? Are you Hershey syrup? What's the concoction over there? How are you putting together this protein-packed beverage? I love chocolate milk. It's one of my favorite things. I drink a lot of milk. Always have loved milk. I haven't had chocolate milk for a long time, though. Let's see. Ace picked up some SCHD, QQQM, and VU. And also some Lululemon. Nice. My man Dave's in the house. Picked up a bunch of Berkshire. Good stuff. Good to see you, Dave. Midway picked up Google, Vici, UNH, and Novo Nordisk. Nice. Yeah, it looked like Dividendology just started a position in Novo. So that's cool. The financials on that one look really strong. I think from my understanding, a lot of people are concerned about their reliance on just the, Ozempic and whatnot. But yeah, those financials are very pristine on that company. Interesting. Striper sold out of Vici and added to Microsoft. I mean, that's not a bad switch. You can't go wrong with Microsoft, but I'm curious to know why you decided to sell out of Vici. What happened there? Yeah, man, picked up 10 shares of Hormel. Drinking Walcott bourbon. Nice. Very nice. Looks like Sysum bought some Visa. Yeah, on the quote unquote dip. DGRO, SCHD, FX, AIX, and Vici. Nice, nice. Oh, there we go. Junior sold Nike for a 14% gain, adding more SCHD. So, I'm curious too. What caused you to sell out of Nike? What was, what made you push the sell button on that one? I'm glad you locked in some profits, but I'm just wondering what you were thinking with that one. My man Teeps is in the building. What's up, Jeff? Picked up some MasterCard and Visa, MPWR, and ODFL. Shout out Old Dominion. Nice move. Let's see. Chris, nice little shopping spree here. VU, SLV, ASML, which is his new position. Amazon, Google, and Apple. Man, no Walmart, huh? No Walmart. Let's see. Thief had to pause active investing due to training period at work. Well, that's okay. You'll get back to it. No worries. D. Connor, ASML, Google, and MSCI. So actually, I wanted to talk about MSCI. I actually wanted to go through it. I think before the stream, ex-Dividend Dad asked for some thoughts about MSCI. So we'll go through that company here in just once I get caught up here in the chat, we're going to take a look at MSCI. But I'll tell you what, this looks and sounds like a very interesting company. So let's see. Nice. Savor the Skies. First time in the live stream. Welcome aboard. Happy to have you here. UNH, SCHD, and JetQ. Nice. Not a bad combo. Drinking some Celsius. I'm always watching the Deep End podcast. Well, nice. I'm hope you've been enjoying that. It's been a lot of fun. It's been a lot of fun being able to have those conversations. And Ari's a good dude. He's a good friend of mine. And I think being able to do this podcast together only amplifies that. So I'm happy to be doing it with him. And I'm happy that you're enjoying it too. Aussie picked up 11 shares of VEU. Fast Eddie, nothing. Water. Okay. I hear peanut. Toan adding UNH, started a small position in Zoetis. Nice. Very nice. Tony, some Costco and Amazon. Can't go wrong with those. Nice. Looks like Mark broke 30K in the portfolio, but didn't invest much this week. Well, congrats on 30K. That's huge. Good job. Fernando wants to know, is starting a position in Zoetis a good idea? I mean, I can't answer that for you. Personally speaking, I've been buying Zoetis pretty much every week. That's what I bought this week. But yeah, whether or not you think it's a good idea, that's something that only you can answer, my friend. Okay, guys, I'm gonna skip ahead a little bit because I'm getting a bit behind here in the chats. Ooh, Dan. Okay, Nesquik syrup. There you go. Nice. Mike, do you play with options? No, not into options. Not into options. Striper, just couldn't deal with the near flat performance of Vici. Just not good at picking REITs. Okay. Let's see. Yeah, this is a good question. Do you have any thoughts of ever doing portfolio reviews of previously covered portfolios, kind of like when shows do update segments on previous guests? It's not a bad idea, but man, I am a long ways before I get to doing that because I just have so many portfolios that have been submitted that I need to get through. So I think at this point I'm up close to 350 portfolios that have been submitted, and so I with that said, I guess what I'm trying to say is I have a lot of portfolios to pull from, and I think that I would consider doing something like this if if I felt like I was I didn't have a lot of options in terms of portfolios, but there's so many portfolios out there for me to still review, and I'd love to be able to get to portfolios that I haven't reviewed yet, just because there are so many out there. I'd much rather do that than go back and revisit portfolios that I've already looked at. Hopefully that makes sense. It's not a bad idea though, and maybe in the future I'll do that, and I'll definitely keep that idea in the back of my mind. Okay. ETWO. Oh man, I've never heard of this company before. It doesn't even look like they pay a dividend. Nice. Okay, Caesar's in the onboarding process with Limits Express. That's awesome. I hope it ends up being a good thing for you, Caesar, and definitely keep me posted on how it all goes. And if you have any questions, let me know too. I should have some inventory finally being sent in next week. Really, really hoping it's next week. I'm really chomping at the bit to get some more sales. So, all right. What's your opinion on NOBL? Let's take a look at that one. And then also I see a question about Viper Energy. We'll take a look at that one next. So let's go look at NOBL. So that is a Dividend Aristocrats ETF, guys. Let's jump over here to Seeking Alpha. Let me see. Okay, so first things first, expense ratio is 0.35%. And obviously based on the title here, title of the fund, we know that this is an ETF that only invests in Dividend Aristocrats, which are companies that have consistently raised their dividend for at least 25 straight years. So pretty solid track record of raising dividends. But yeah, so we're starting here with an expense ratio of 0.35%. Let's see, how long has this fund been around? It looks like it's been around for a long time, at least for the last 10 years. Maybe it'll tell us when it was. Okay, so it was formed on October 9th, 2013. So it's been around for, almost 12 years, at least a decade. That's a pretty solid track record. And in that time, it's up 143%. Just looking at the share price, we can take a look at the total return and compare it to some of the other ETFs out there here in just a moment. But, we'll take a look at a few of the holdings. I mean, interesting top holdings. Emerson Electric, I've heard of that company. It's a utility, right? But I'm not super familiar. I don't think I've ever actually looked into it. No, it's not a utility, excuse me. Technology and software company, huh? Interesting. Okay. Let's look at the dividend stats, actually. Oh, look at that. I don't know about that. You can take a low yield, but if you're getting a 5-year growth rate that's lower than the dividend yield, I don't know. But we'll add it to the watch list so we can keep an eye on it here. Okay, but let's go back to an NOBL. IBM, Pentair, Ecolab, solid company. Yeah, I don't know. I don't know that I'm too crazy about these top 10. There's a couple in here that I like Caterpillar. Franklin Resources isn't terrible. IBM's okay. Ecolab, Looking at the dividend stats, I don't know. 2.13%, 6.35%. Pretty lukewarm dividend stats. You know, obviously with something like SCHD, you're getting better stats. But let's compare it to some other ETFs. Let's compare it to like, let's go VOO. Let's do SCHD. What other ETF should we compare it to, guys? And real quick, I see a holy cow, guys. Alberto, what are you doing? $100 super chat just to say hi. My goodness. My friend, thank you so much. That's I think this might be the highest super chat I've ever received. So, whew. Thank you, man. That's huge. Oh, Midway signed on with Limits Express too. Nice. Yeah, man. Let me know how it goes for you too. But yeah, what other ETF should we compare it to? So okay, DGRO, I see. Nice. Chris asked about or said something about traders. So okay, I'm getting too distracted. Sorry. Okay, so DGRO, SCHD. Any others? Well, how about VIG? VYM too. We can compare the total returns here. So okay. SVOL, FDVV. How many? I think we can only add one more. So FDVV. Okay. This one's I've been seeing a lot of people bring up FDVV a bit more lately. Okay, so let's across a few different time periods over the last year. Yeah, I mean, over the last year, both NOBL and SCHD have underperformed the rest of the group here. Let's go over the last 5 years. Okay, so this one's underperformed everything else. Over the last 10 years, yeah, so it looks like it's underperformed. It looks like it has underperformed everything over the last 10 years. So here's what I'm gathering about NOBL. So we're getting an ETF of dividend aristocrats with an expense ratio excuse me, that's higher than a lot of these. What is FDVV's expense ratio? Because that's the only one I'm not familiar with. I think the expense ratio on the rest of them is less than 0.1%. I could be a bit wrong on that, but most of them are definitely less than 0.1%. FDVV's is 0.16%. So that's still half, actually less than half of what you would get from NOBL or have to pay for NOBL. So you're getting a higher expense ratio with dividend stats that, at least in my opinion, are not as adequate as some of the other options. I mean, even if, guys, if we go back and look at FDVV, you get a higher starting yield and a higher 5-year dividend growth rate. So it loses out in expense ratio, it loses out in dividend stats, and it also loses out in total return. So beyond just getting exposure to dividend aristocrats specifically, which sounds nice, it sounds nice to only invest in companies that have these long track records of paying dividends. But yeah, you're suffering in all the other departments. So with that said, I don't think NOBL is quite worth it. And also just kind of zooming out beyond that, I it's nice to see companies with these extensive track records of paying dividends, the dividend kings and aristocrats. It's always great to see, but you shouldn't just buy a company or an ETF just because it's a dividend aristocrat or has dividend aristocrats or dividend kings. Obviously there's a lot more that you need to pay attention to, and that's just one of the factors. It's just a cool title to have. It's kind of like bragging rights, I suppose, and it is nice to see, but it kind of pales in comparison to a lot of other things you should be looking at, in my opinion. So I personally think there are better funds than NOBL. Yeah, Striper. We'll take this is a quick opinion on MLPs. Yeah, we'll answer this right now. So MLPs are just businesses that are, they're structured a little bit differently than your normal company, like a Procter and Gamble or even a, like a REIT or a BDC. They're a little bit different in the sense that the dividends you receive from them are not included on your 1099 form. You're actually considered a limited partner of these companies. So like an MLP like Enterprise Products Partners, you're one of the limited partners when you become a shareholder or a unit holder. And as a limited partner, you get a whole separate tax form. You get a Schedule K-1 form that shows your portion of the business's income or losses for that year. This is the same form that you would get if you had like an LLC or whatever. You'd still get a Schedule K-1. And so a lot of people don't like MLPs because they don't want to deal with that extra tax form. But and bear with me as I try and explain this. Basically, the profits and losses that you get, or the dividends that you receive, or the distributions as they're called, really different names for the same thing, but the dividends that you receive or the distributions you receive from these MLPs are counted against your cost basis in the investment. So it reduces your cost basis. And because it does that, the distributions that you receive are not taxed, essentially. And I'm probably oversimplifying this, so definitely look into it on your own. But that's kind of the gist of how it works. And that occurs until the cost basis is reduced to the point of basically being zero. And then at that point, you pay the long-term capital gains tax rate on those distributions from that point forward. But once again, a lot of people don't like dealing with the extra tax form or the extra form come tax time. Personally speaking, as someone who's owned an MLP for the last 3 years at this point, I think I've had EPD, maybe 2 or 3 years, somewhere in there. I think I filed, taxes for 2 years being an MLP owner. It's really never been an issue. The first 3 years, the first couple of years, I did it through TurboTax on my own. It was pretty straightforward. And then I have a CPA that handles my taxes now, so I don't have to worry about it at all. And so, yeah, for me, the MLP really hasn't been a big headache. If you do own an MLP or are considering it, one thing to keep in mind, or one thing to note, is that you don't want to own them in retirement accounts. Like, you don't want to put an MLP in a Roth IRA. Because of how the company is structured and because of the reduction in the cost basis from the distributions, it causes problems when you put MLPs in a Roth IRA. So they're best held in a taxable account. I probably missed a lot of stuff in there, but hopefully, Striper, hopefully that made sense, and hopefully that gave you some good insight. Hopefully. Yeah. Okay. So we got a few other good questions here. Other stocks. Okay. Let's see. Okay, guys, I'm just scrolling down here. Okay. So let's go through this next one. Let's go through Viper Energy, VNOM. And I remember going through this one a couple months ago here on a live stream, and I remember liking it at the time. So let's check it out again. Let's see what we can find here on Snapstock. So and we were also going to go through MSCI. We'll do that right after this one, okay? And is Viper a... They're not an MLP. Mineral interests and okay. So is this kind of a is this kind of like a Texas Land Pacific where they basically just they make money from royalties? That's kind of what it sounds like. But anyway, revenue and earnings look great. So really solid growth there. Free cash flow for the most part has been negative, but I'm wondering if that's just something that comes with the territory of a company like this. And for example, if we go over to no, not EPD, like maybe like an energy transfer, or no, there's another type of what's TPL? There it is. No, what am I thinking of? Anyway, I'd have to look more into why the free cash flow is negative, but I think that that could have something to do with just the structure of the business. But otherwise, growth in revenue and earnings look pretty solid. Interest coverage is kind of declining. Solid dividend growth. I wonder if they pay special dividends. I wonder if that's why we're seeing the choppiness here, or if they just have reduced their dividend in these years. I feel like this is one that I'd really need to spend more time with. It's seemed like it's not as straightforward as looking at like a Coca-Cola or Procter and Gamble. So okay, so similarly to an MLP, you'd want to look at distributable cash flow, which could be different than the free cash flow. Okay, so I was kind of on the right track. And the dividend stats look nice too. What was it, like a 6-something% yield, 10% 5-year growth rate, 1-year dividend growth? So maybe their dividend policy is such that they only pay out a certain percent of earnings or free cash flow, and then it goes up and down based on that. Okay. Base annual dividend. Oh, okay. This is nice. Huh. Oh, that's just based on the per barrel price. Okay. Yeah, I don't know. I would need to spend. I would really need to spend more time with understanding this one and how it all works to give a better opinion on it. Huh. Okay. I probably didn't answer your question at all, but I don't. Yeah, like I said, I just need to spend more time with it. Okay. Let's show. Oh yeah, we're gonna look at MSCI. Sorry. Let's do that. Okay. This one's much more straightforward to look at. So in case you guys have never heard of this company, MSCI, They do a couple different things. The first of which is they put together stock indexes. So, for example, they have the MSCI World Index and some other indexes like that, and then they make money basically off licensing. Um, I don't know, licensing the information about that index to other companies that make funds that track the index. So, like for example, I'll try and explain this. So, for example, let's look at SCHD, right? SCHD tracks the Dow Jones US 100 Dividend Index, and basically, SCHD makes money charging management fees to the people who own SCHD, but then they also have to pay fees to Dow Jones to track the Dow Jones US 100 dividend 100 index, whatever it is. And so MSCI kind of works the same way. It actually works the same exact way. The funds and the companies that want to create products that track their index, they'll make asset-based fees, asset-based revenue from those funds. And the more people that invest in the funds that track MSCI's indexes, the more money that MSCI will make. But they also have like analytics and analytics software and data and stuff like that. That's another revenue stream for them. And there may be more to what they do, but I think that's kind of the bread and butter. So let's anyway go back over here. Looking at the snap score, it's actually very solid, almost perfect. Actually, growth is almost perfect. Profitability is perfect. Debt's looking good. Dividends and buybacks, everything's just looking really top notch. And so with that, if we scroll down, I mean, this is exactly what you'd want to see. These are very Visa-esque growth charts right here. Everything just up and to the right. And at really solid percentages too. I mean, double-digit growth rates across the board. So yeah, I mean, I don't know what more you could ask for with that. Obviously, very high margins, which makes sense. I mean, they're basically just collecting fees. It's not a very capital intensive business. So it's no surprise to see the cost of goods sold low in relation to the revenue that they're generating. But even the net profit margin and free cash flow margins are looking pretty good, close to 40%. In some years it's actually over 40% and growing. We can definitely see it's growing here with the free cash flow margin. So this company is becoming more profitable over time, which is just another big green flag or another great check mark for them. With that, debt has been on the up and up very consistently. In fact, they've added debt at quite an aggressive rate. On average, they're increasing their amount of net debt by about 17.5%. So that's a pretty big chunk. And for a while there, the net debt to free cash flow was creeping up, never to the point where it was, concerning. At the highest, it was 3.64. So, that's still definitely manageable. And it looks like it has kind of retracted a bit in 2024. So I think that's a great sign. Interest coverage is increasing as well, officially above 8 in 2024. So that's looking good. I would say that this is maybe the only thing I'd want to keep an eye on so far with this company is the debt. Like I said, relative to their free cash flow, it's not terrible, but potentially if free cash flow were to slip or if something were to happen and they, financially going through a tough time, this could pose a problem. And interest coverage is just kind of barely above the threshold I'd like to see it, which I'm actually surprised by this. I would have thought with a company that's not so capital intensive, a company that is as profitable and growing as much as this one is, I would have expected to see interest coverage a lot higher than it is. Not that that's bad. That's just something that I was surprised to see. And the trend is heading in the right direction. So I think that's good. And if we scroll down looking at the dividend stats, I mean, no surprise, this company's been a very aggressive dividend grower over the years. You're not getting the highest starting yield. So if you're someone who's close to retirement or dividend income's a bit more of an immediate need for you, this may not be a good one to consider. But, for us youngsters who still have a good, 10, 15, 20 years before we start pulling our dividends, this might not be a bad one to consider. We can take a low starting yield of 1%. And if it continues to grow at even, half this rate, I mean, hopefully it doesn't slow down by 50%, but even if the dividend growth were in the 12 to 15% range over an extended period of time, you'd still make out pretty well. And it looks like the dividend growth has been decently consistent these last couple of years. It has slowed down, and we'll see where it goes from here. But yeah, I don't know. I think there's a lot to like about it. The payout ratios do look to be increasing, though. That's another thing. Kind of like the debt. This is another thing that you'll want to keep an eye on. But it's really not bad. It's gone from, mid to high 30s to now like mid 40s. So still plenty of room to continue growing and paying the growing. Yeah. I don't know why that sounded wrong coming out. Plenty of room to continue growing and paying the dividend. Same is true with the free cash flow payout ratio. But once again, this is on the up and up. But still, like if it's peaking at 38%, could be doing much worse. And no surprise too, like very strong returns on invested capital. Since 2018, it's pretty much gone up every single year. And even then it was over 20%. And so I don't know, I'd be surprised. Like if this all continues, I'd be very surprised. Even buying at current prices, I'd be surprised if you didn't generate some solid returns. But with that said, I mean, free cash flow yield of 3.2, earnings yield of 2.5, very high PE ratios and price to free cash flow ratios. You're definitely paying a premium for what it looks to be just based on the financials, a high quality business. So yeah, there's a lot to like about it, which makes sense why it's up 21% in the last year. So and that's the usual trade-off, All right. Oh yeah, shout out Gangstar. Nice. All right. Captain Prox has a great question. As far as this is a good question too, as far as when Snapstock will be available, which by the way, that's the platform we've been looking at, guys, Snapstock. I don't know. I don't have an exact date for you. The developer who's the magic man behind this, he's in the process of starting a new job and moving. And so it's been a little bit slow moving behind the scenes, still making progress, but it's been a little bit slow moving behind the scenes. Hopefully in the next couple of months or the next few months, we'll roll Snapstock back out. And when we do, we'll be re-releasing it as its own standalone platform. So for the first initial test group, it was attached to the investment club. So you got some other stuff with it, like my stock research, book notes, template to the Investor's Almanac, which is what I use to log all of my stock research and book notes. So you got a copy of that tool as well. But when we roll Snapstock back out, it'll just be its own standalone thing. So yeah, and I wish I had an exact timeline for you or an exact date, but we're not quite there yet. But it'll come. It'll come for sure. So, and I'll definitely keep you posted too. If you want to stay in the loop, definitely subscribe to the waitlist or sign up to the waitlist if you haven't done so already. There's a link to that in the description of the video. So yeah, ex-dividend dad, good question too. We'll go through that. Man, time's already flying. I didn't realize it's already 5:40. Holy cow. Okay, so let's go through these other questions. So Fernando wants to know about Thermo Fisher. I'm not familiar with this company. I don't think I've heard of this company, but let me see if I can find it. TMO. Okay, let's see. Wow, down 24%. Yeah. Oh, wow. What does this company even do? Why don't we start there? Okay, life science solutions, analytical instruments. Okay. So they make kind of like medical tools, medical devices, stuff like that. Lab products. Maybe not medical devices, I should say, but lab products. Okay. Decent snap score, growth. I mean, the growth chart looked pretty good from what we saw. There's some good, there's some bad. Let's just see what we're up against though. So I think growth has been solid. Where's my Fresca? Oh, shoot. There it is. Growth has been solid for the most part. It looks like it's kind of hit a snag here since 2020. It's had its ups and downs, but it's hovered within this range for the last 5 years. And it looks like revenue's kind of stagnated as well these last few years. Free cash flow, same thing as the revenue, very stagnant, which means, and we'll see when we get down to the dividend section, but if they've continued to grow their dividend, but the earnings and free cash flow have not seen much growth, we'll see an increase in the payout ratio. So that's something I'm prepared to see when we get there. For the most part, it looks like margins have been consistent. Gross margins, maybe not so much, going from 50% down to about 50% down to about 40%. So we've seen about a drop of 10% in the gross margins over the last decade or so. It looks like the net profit margins have actually gone up. So that's good. And free cash flow margins have been steady. Like to see that. Net debt, not in a bad place. Looks like it has jumped up. And it did jump up in 2021. It paid down a little bit and it's hovered there. But for the most part, the net debt to free cash flow has been declining, and it's in a pretty fine range. You know, less than 4, we'll take that. Interest coverage is a bit low though. That is one thing. Yeah. So okay. Yeah. Okay. So this is interesting. So we know that we're already getting a starting yield, 0.4%. So very, very, very low yield. You know, pretty decent dividend growth though, you know, 15.4% over the last 5 years. You know, just based on this already, if I would sooner invest in like an MSCI. I know totally different industries, totally different. But you know, I'm just going off of what we've looked at today. I think that is a much better looking company. Even Zoetis, like even just based on everything we've seen here, I'd rather invest in Zoetis. Higher yield, higher growth rate. But even with that, looking at the payout ratio, so they are going up, you know, like we thought we'd see, but yeah, this is totally fine. I mean, less than 10%, both looking at the earnings and free cash flow payout ratio. So definitely not a concern there, and actually very low returns on invested capital. Yeah, so that's not super exciting either. And comparing that to something like a Zoetis, just for example, I mean, we're getting much higher returns and growing returns from Zoetis. And, you know, different industries too. I mean, Zoetis is more pharmaceuticals, whereas, Thermo is more, you know, lab products. So they do different things, but in the same sector. And like I said, you're getting almost 3 times the dividend yield with this. And you're also getting 6 percentage points more in the dividend growth. So, and they're buying back shares. But with that, you know, you're also seeing the payout ratio go up here with Zoetis. So definitely something to keep an eye on, but still not bad. 34% free cash flow payout ratio here. Yeah, so that was an interesting one. Like I said, I'd never heard of that one. I'm actually going to add it to the watch list just to keep an eye on it. So thank you for sharing that with me. I will say though, what was the, yeah, okay. Oh no, this is Zoetis. Let's go back here. Free cash flow yield and earnings yield are a bit higher, so valuation is going to be lower, but still. Okay, let me see what I missed here in the chat. Okay. Yeah, so Western Union, I'm not a fan of. I don't want to. Well, yeah, I think it's important that we probably look into Western Union. We're just going to look at Western Union, if that's cool with you, because we've got a couple other questions here, and I don't want to run out of time. But I'm not a fan of Western Union. The valuation's crazy low. Look at these numbers right here. Crazy low valuation, crazy high dividend yield. Surprisingly, the earnings per share has been growing and free cash flow per share has kind of, no, I guess, I mean, it really has declined, right? It really has. Revenue is definitely declining too. I mean, yeah, that's not good. Even though earnings per share has been going up, so they're doing a great job of cutting costs and trying to be more efficient as they move down the income statement. Sales is very important. If the company's sales are declining, the customers are, for some reason or another, are finding less of a reason to spend money with them. And to my understanding, and correct me if there's more to it in the chat, but to my understanding, the big draw to Western Union, or the way that they make most of their money, is just like cross-border money transfers, right? And I feel like in this day and age, that's such an easy thing to, I don't want to say disrupt, but there's so many other options to do exactly that. So, yeah, like Jay here said, Western Union has too many competitors. Yeah. Okay. So that's exactly what I was thinking. But Lewis says, sign up for a newsletter. Haven't received this spreadsheet, Ryan. Any help? If you just signed up for it, give it a couple minutes, and I'm sure it'll come. Check your spam folder as well. If it's been some time since you've signed up and you haven't received anything, just send me an email at ryan@retirewithryan.com, and I will make sure that you get the link to the spreadsheet. I'll personally send it to you. Okay, so this next question, guys, from Captain Prox, really good question. I know you like to invest in sectors within your scope of knowledge. I was just wondering if there were any sectors you were wanting to branch out and learn more about. Yeah, that's a really good question. This year I've been trying to learn a bit more about like the healthcare sector. I guess what I'm trying to do is I'm trying to go a bit deeper in the sectors that I'm already in. So I'm trying to learn more, about healthcare. I read a really good book. Let me find it. Right here. I read a really good book earlier this year called 10 Drugs. I'll hold it up here. 10 Drugs, How Plants, Powders, and Pills Have Shaped the History of Medicine. So you get a lot of good backstory. On how some of like the biggest, drugs were made. And a lot of them have come from opioids. You get to learn about the difference between opioids and opiates. So a lot of them have come from opium. Sorry, guys. Peanut wanted to look out the window. But then it kind of takes you from the origins of medicine in that regard to where we're at today. And there's been a big shift in how they approach pharmaceuticals. It used to be a lot more chemistry based. And now they're moving into things that are more biology based. So that's when we get into like monoclonal antibodies. It's less chemistry, it's more biology. And the same thing when it comes to like genes and stem cells and stuff like that. So I'm trying to read more books like this that can maybe give me some more insight on these companies. I've got a few more on my reading list that I need to buy. I have a couple on my reading list that have to do with like, payment networks and the future of payment networks and the future of transacting, just kind of where that's headed. And that when I'm learning on all this stuff, that's kind of like, those are kind of the sources that I look for, is books that can kind of teach me about it. And also I've just been chatting a lot to chat GPT as well. And when I say chatting, I mean actually like talking to it. I don't know if you guys have used this yet, but you can actually talk to ChatGPT, have a conversation with it. So if I get curious about something, I'll just hop on there real quick and say, hey, tell me about this, that, or whatever. And I'll just kind of let my curiosity follow me in that conversation, or I'll follow my curiosity in that conversation is what I'm saying. And that's been that's been cool too when it comes to learning about individual companies or about the industries that they operate in and stuff like that. So yeah, I would say that, I don't know. I don't know if that answers the question really. But yeah, generally I'm trying to go a bit deeper in the sectors that I'm already in. And I think that that's going to branch out into other things as well naturally, but it's not necessarily something that I really plan for that much. I just kind of am following what sounds interesting or what seems interesting and letting that be the guide. Um, letting that be my guide, I guess. I also have a couple like Web3 books too that are on my Amazon list, but I'm just kind of going for things that I'm curious about. And I've found too that doing that has, it kind of leads me to, in doing so, I can learn about new companies, or I can maybe understand better the companies that I already own and stuff like that. I don't know. I know that's a very roundabout answer, but hopefully that some of that makes sense. So yeah, I would show you Peanut. I'd have to like take my camera off the stand here though, and that's just a whole to do. Oh, you want to see the watch? Got the Seiko S. What is it? SNX SX. What do we got here? It's the, I don't know. I don't remember the model number, but it's the Seiko Solar Diver, 38 millimeters, I think. This thing pretty much lives on my wrist. I pretty much wear this every day. Pretty much every day since I got it about a year and a half ago, I've been wearing this. I love this watch. Okay. What else we got? We got one more great question from X Dividend Dad here. What's been, and this is probably going to be the last question, guys. Let me put this book up real quick. Yeah, this will probably be the last question of the night. And this is a great one. So what's been the toughest breaks for you this first half of 2025? Anything you wish you did or didn't do? I'm going to save this one because this is great. Maybe I can touch on that in a future newsletter or video. And sorry, I wanted to save the last question that we just went through too, because that was really interesting. Thank you guys for the great questions. This is fun. I knew this was going to be a fun stream. Okay, so yeah, so what's been the toughest breaks? Anything you wish you did or didn't do? Just strictly talking about the portfolio. Anything you wish you did or didn't do? Yeah, one of the first things that came to mind, it comes to mind for me, is I wish I would have waited to buy Clear Secure. I really jumped the gun on my entry into this position. I started buying the stock when it was in the 30s after it had already seen like a pretty nice run up. And I'm really excited about this company too, don't get me wrong, but I think I should have waited a bit longer. I should have been a bit smarter with my entry into the position, because ever since I owned it, I've pretty much been losing money on it. And if I would have just waited like another month, during which time I was like researching the company anyway and spending time with it and learning more about it. But if I would have just waited like a month, I would have been able to buy this stock and start my position in the mid 20s. So maybe not a month, but if I would have made it waited a couple months, that would have been the case. So I think that's something that I could have done better. And in thinking about why I did what I did with Clear, historically, and I've talked about this before. Historically, I've kind of done the opposite. I've been very slow to start new positions. And a really good example of that is Rollins. You know, and you guys know what happened with that one, but I was so slow to, I just wanted things to be perfect with Rollins. I just kept waiting. I kept waiting. I kept waiting. And I was way too slow to pull the trigger on it. And I think a good opportunity passed me by. I might get the opportunity here in the future. We'll see what happens. But, you know, being able to buy, in hindsight, being able to buy it in the low 30s when I first was interested in buying it would have been so nice. Like I should have just done it. And so I think that my entry into Clear Secure is kind of a, you know, a response to that, where I wanted to take the opposite approach. And so far, I think from a long-term perspective, I'll be fine. But so far, it's not really proving to be my best decision. So I think that's something that and that didn't happen in the first half of 2025. That was like late last year, but that is something that I could have done better. The only other substantial move that I made, I mean, moves. Let me just show you guys the spreadsheet real quick. Let me just show you what I'm looking at here. So, and I'll zoom in too, so it's a little bit bigger. And here's Clear Secure, by the way, guys. My average cost is $28.91. The current share price is about $1.30 below that. So, and it's making its way back up. You know, I'm only down 4%, including dividends. It's, you know, only down 2.5%. But still, the situation could be a lot better. So, but in 2025, like the only thing that I've really done is I added Zoetis to the portfolio. I feel really good about that one. Yeah, I didn't really rush that one. I didn't really sit on my hands with that one. I think I bought it at a good price after the stock had seen a pullback. I'd done a decent amount of research into it, enough that I would feel comfortable starting a position. And another thing that I've learned too, sorry to sidebar, but I think it's worth sharing. Another thing that I've learned too, just from investing, is you really learn a lot more about a company after you own it. And that, you know, in my experience, I found that to be true. So, and I think that was something that I had to learn the hard way with Rollins. Like I don't know, maybe I felt like I didn't know enough about it, or I felt like, I don't know exactly what it was, but yeah, you tend to learn a lot more about companies once you actually own them, versus if you just, you know, continue to look at them and continue to research them without actually pulling the trigger on it. There's something about actually, and I guess maybe it's that ownership bias. Maybe you feel a bit more of a sense of responsibility to stay on top of it. And so I don't even know what my point was in this sidebar, but yeah, I guess what I was trying to say is I felt good about what I did with Zoetis. I did enough research to feel good about owning it. And I know that now as an owner, I'm going to learn a lot more about it as time goes on. Just from being an owner, it's going to add that element to it. But then otherwise, the only other big move that I've made so far in 2025 is selling out of Altria Group. And I feel really good about that decision. You know, so far, the more that I think about that decision, the more happy I am with it. And it was a bittersweet sell, because, you know, that was one of the first companies that I bought when I first got into dividend investing. And so I'd held it for a long time and it'd been a good investment. But yeah, like I said, the more that I think about that move, just the better I feel about it. I don't know. As time had gone on, I became a lot less enthused about their transition and their ability to kind of, because they basically, like, for their turnaround to work, quote unquote turnaround or transition or transformation is probably the best word. For their transformation to work, they have to disrupt themselves, and they have to basically disrupt their main revenue driver. And I don't know, so far it just doesn't seem to be playing out that well. And yeah, so I guess with that said, I feel like I could go on a tangent about that. But with that said, I feel really good about the moves that I've made so far in 2025. The most recent move that I think I could have done better is, at least so far, is Clear Secure. But once again, I think over a long period of time, I think time will be forgiving with that one, especially if the company just continues on their trajectory. So, and I think they're making a lot of great investments for the long term, to mitigate some of the risks that come with investing in that business. So hopefully that all plays out. I will say that is Clear Secure is probably the riskiest company in my portfolio. It's certainly the most volatile company in my portfolio, but I also think it is the one that poses the most risk. I would say that prior to selling out of Altria, that was one of the other ones that posed the most risk in my portfolio. But right now it's Clear Secure, and fortunately, it's not too big of a position. It's 4.4% of the portfolio. I shouldn't say only, but I have, about $3,700 invested in it. That's my cost basis. And at the end of the day, if hypothetically the stock went to zero, it would suck, but it also wouldn't be the end of the world. It's certainly not going to take me out of the game. And overall, just in terms of portfolio construction, I'm really happy that I have structured my portfolio this way, where I am diversified. I don't feel too over diversified, but I also don't feel too concentrated where, certain risks, or certain businesses not going the way I think they will, could take me out of the game. I'm just glad that that's not much of an issue. So you guys like this Gangstar shirt. I love that. Thank you guys. Yeah. Yeah, I think we all have a tendency to be like this too, slow rolling into positions. And I think that's good. There's obviously a sweet spot, but I think it's better to take your time when it comes to starting new positions, because I think it indicates a bit more seriousness. Because it's a big decision. I think if you're taking a long time to make the decision, it's something that you are, you put a lot of weight into, and it's not, even though you could sell it you could buy a stock today and sell it tomorrow. The fact that you take so long to deliberate over it tells me that you're not one to sell in and out like that. And I think taking a long time to start a new position just comes with having a long-term mindset. And it kind of goes back to that thing Warren Buffett used to say about the punch card. Pretend that you've got a punch card with only 20 punches in it or whatever, or even 10, whatever the number is, and you can't go past the number of available punches. And so when you think about the stocks that you buy as a punch card that you can't get back, it makes you think about it a bit longer and a bit harder. But like I said, there is a sweet spot. You have to know, you have to do enough research that you feel either good about starting the position, or enough to know it's not going to be for you. And then, like I said, you tend to learn more about these businesses over time. And one thing too that I am learning and will continue to learn as time goes on and I get more experience, is that you do start to recognize patterns between different businesses. You start to recognize certain things that I think help make the research process a bit quicker. And you start to recognize, patterns in quality and whatnot. And I think that helps too. And that can only come with experience. And that's, like I said, that's something that I'm still learning. I'm still figuring out those patterns. So, let's see, guys, but I think that's about all I got for you. Oh, that's really cool, Striper. Nice. Sam, how's WFS? It's good. I actually have not generated any sales in June. I'm waiting for inventory to be sent into my store. I'm hoping that some of it will make its way to, I'm hoping that some of it will make its way over to Walmart next week, and I can start getting some sales in the next couple of weeks again. I'm really chomping at the bit. But yeah, it takes time. That's been a big learning lesson for me with this, is everything takes time. It takes time for them to, get the inventory from their suppliers. Like, for example, one of the products that I am going to be having in my store this next month had to come all the way from California. Their warehouse is in Massachusetts. So the shipping time to get it from the supplier to Limit's warehouse, and then for them to process all of that inventory, apply it to your store, that takes time. And then for them to ship it into Walmart's warehouse, that obviously takes time. And then for Walmart to apply it to your store, that takes time as well. So it's been a real test of patience for me in a good way. But like I said, I'm really chomping at the bit, and I'm really excited to start getting some more sales because the first round really went so well. And I'm just excited to get this next round going, but it takes time. So yeah, how much are you up year to date? This will be the last question. So according to Snowball, let's go over here. According to Snowball Analytics, which you guys should definitely check out. There's a link to it in the description. Hands down, my favorite portfolio tracker. You guys would love this if you're not already using it. Real quick, just looking at the performance against the S&P, NASDAQ, and SCHD. I am underperforming year to date, both SCHD and NASDAQ. We are beating, did I say SCHD? We're underperforming the S&P and NASDAQ. We are outperforming SCHD. Year to date, it looks like I'm up about 2.5%. So not too bad. And then over the last year, it looks like I'm up 13.2%. So that's where we're at. And this is a breakdown of my monthly returns so far for the year too. So March and April were pretty tough. Not a lot of action in May or June either, but it's all good. It's all good. Still have a lot of year left. But anyway, guys, yeah, we are officially going to wrap it up here. Thank you guys all so much for the great questions, for the fun stream. Some of these really made me think long and hard about them. Oh, nice. Yeah, solid performance, 11.6% for the year. Nice. Anyway, guys, yeah. Thank you guys again. Really appreciate all the support. Definitely check out tomorrow's video. I'm going to be going through all of my dividend income for the month, including my projected SCHD payment for this month. I won't spoil the exact amount, but guys, it's been a really, really, really solid month of dividends. And I'm excited to go into all of the details with you guys. Jack, good to see you, man. I hope all of you guys have a great weekend. Definitely check out that video. Like I said, it's going live first thing in the morning, and drop a comment on that. Hit the thumbs up on it. But yeah, I hope you guys all have a great weekend. Caesar, shoot me an email if you have any questions. My email is ryan@retirewithryan.com. But anyway, guys, hope you all have a great weekend, and I will see you in the next one.